Welcome to the Deep Dive. If you've been paying attention to the financial news at all, you've probably heard the same story for, the last year now?
Mm-hmm. The standard narrative.
Right. Inflation is moderating, the job market looks stable, and, nominal yields are fantastic. I mean, we're seeing money market funds paying 5%. That's a number we haven't seen consistently in over a decade.
It feels like a return to normalcy in some ways.
It does, but here's the thing. If you are a sophisticated investor, someone who operates in the top tax brackets, you are likely feeling, a profound sense of anxiety. Because despite all the robust headlines, you are probably losing real purchasing power.
It's the great financial contradiction of 2026. This is exactly what we're calling the wealth preservation paradox.
The wealth preservation paradox.
Yes, the market is, it's giving you all the tools to succeed. High yields, strong corporate performance, but the actual mechanisms you traditionally rely on for safety, they're actively destroying your wealth once you factor in inflation and, crucially, taxes. The game has just completely changed.
And that's exactly why we're here today. The old playbooks, I'm talking the standard 60-40 balanced portfolio, or just throwing money in a simple index fund in a taxable brokerage account, they are, and we'll show this, structurally broken.
They are.
So our mission for this deep dive is not just to summarize what's happening. It's to provide you with the essential financial, the architectural blueprint necessary to combat what's known as the money illusion.
And our source material for this is the 2026 Money Illusion Report. It really delves into the interaction of three relentless forces. First, you have sticky normalized inflation. We're talking 2.5% to 3.0% as the new baseline.
Not going away.
Not going away. Second, that's combined with those higher nominal interest rates. And third, and this is maybe the most critical piece, is the new cemented tax landscape established by the One Big Beautiful Bill Act, or OBBA.
The OBBA is so crucial here because it basically codified a new reality for investors, didn't it?
It did. It locked in high marginal tax rates, it locked in complex regulations, and it officially declared the death of what we called the easy beta era.
Explain easy beta.
That was the period where you could just passively invest, buy the index, and expect the rising tide of the market to solve all your problems. That tide is still rising, but the leaks in the boat taxes and inflation are now bigger than the lift from the tide for many people.
So the central thesis we're going to explore today.
Yeah.
What is it?
The thesis is that success in this new environment demands a revolutionary architectural approach. It requires the explicit, almost surgical separation of beta, that's your core market exposure, from alpha, your active return strategies.
Okay, separating beta and alpha.
And all of it, every single piece, must be optimized through extreme tax engineering. The goal is to make sure that the return you earn is the return you actually keep.
It sounds complex, but I imagine it's absolutely essential for anyone focused on capital preservation and growth in this high tax, high inflation reality of 2026.
It's the only way forward.
Okay, let's unpack this. Part I, where the trap really begins. The macro-psychological trap of money illusion.
Right. We have to start with the cognitive bias, because this is really the foundation of why the current environment is so dangerous for unwary investors. The core concept is money illusion.
No, this isn't a new idea, is it?
Oh, not at all. It was defined by the economist Irving Fisher decades ago, but it's become acutely relevant right now.
So can you break it down? What exactly is money illusion in simple terms?
It's the cognitive tendency to confuse the nominal value of money, the number you see on your statement, with its real value, which is its actual purchasing power.
So if my account statement shows a 5% gain...
Your brain registers profit. It's a win, even if the cost of living inflation rose by 3% in that same period.
The gain is salient, the loss is silent.
That is the perfect way to put it. And behavioral finance scholars, people like Modigliani and Cohn, have proven this bias exists. Our cognition anchors heavily to those large, easily computable nominal values. We're just hardwired to look at a 5.0% yield on a money market fund and think, this is safe. This is where I go to avoid volatility.
I think the biggest driver of this right now is just the memory of the last, 10, 12 years.
Absolutely. The ZIRP era zero interest rate policy.
For a decade, a 5% yield was unthinkable. Cash paid next to zero. So seeing 5% today feels like winning the lottery, even if, relative to inflation, it's not really a win at all.
And that's why the report calls the current situation a nominal yield trap. The Fed, by pushing rates up to fight inflation, has inadvertently created the most dangerous illusion for wealth preservation.
How so?
Because investors are flocking to cash equivalents, T-bills, money market funds, They're seduced by the optical safety of that 5.0% nominal number. They see the equity market's volatility as the primary risk to avoid.
But you're asserting that in this specific environment, avoiding that volatility by running to cash, it's mathematically equivalent to signing up for a certain guaranteed loss.
It is a certainty for the high bracket investor. And let's just walk through the math. Let's use table 1 from the report because this is the arithmetic of wealth destruction and it's critical for you to really internalize this process.
Okay, let's do it. Our starting point. A money market fund yielding 5.00%.
Correct. And our baseline inflation, which we've established, is sticky due to, rent, services, wages. We'll call that 3.00%.
Okay, so on the surface, you feel like you've captured a 2.00% real return. Simple enough.
It feels that way. But now we introduce the inescapable reality of the tax hurdle. The OBBBA cemented the top federal marginal tax rate at 37%. And because interest income from cash and T-bills is taxed as ordinary income, it gets hit with that top rate. Plus, we have to add the 3.8% net investment income tax, or NIT.
So even before we touch state taxes, the effective federal tax rate on that interest is 40.8%. That's a huge bite.
A massive bite. Let's quantify that drag. If you earn 5.00% nominal, a 40.8% federal tax translates to a drag of modest 2.04 percentage points right off the top.
Wow.
We need to be realistic about the investor we're speaking to. They often live in high-tax jurisdictions.
Right. Let's add an estimated state tax, say 13.3%, which is pretty standard for top earners in states like California or New York.
That adds another drag of negative 0.67%. So let's sum up the damage. Federal tax drag is 2.04%. State tax drag is 0.67%. The total tax drag is 2.71%.
Which means that out of your original 5.00% gross yield, a full 2.71% goes straight to taxes.
Right. And that leaves you with a nominal after-tax return of just 2.29%.
And here comes the punchline.
Here is the brutal moment of truth. We now apply the real enemy. That 3.00% sticky inflation. When you subtract 3.00% from your 2.29% nominal after-tax return, you're left with a negative 0.71% real after-tax wealth impact.
Negative 71 basis points. So you worked, you saved your money, you made what you thought was the safe decision. And the government and the economy collaboratively just eroded your purchasing power.
They did. That pain is real, and it compounds every single year.
It's the ultimate irony, isn't it?
It is. The report emphasizes this insight quite heavily. People chasing the nominal safety of cash are actually acting as structural economic stabilizers.
What does that mean?
They are effectively subsidizing those who are invested in equities, the S&P 500 people, by guaranteeing themselves negative real returns. Their cash holding is a guaranteed loss of purchasing power, which frees up capital to flow toward more productive inflation-hedging assets like stocks.
That's a staggering realization, that seeking comfort in cash is now an economically destructive decision for yourself, but a stabilizing one for the system.
Precisely.
Okay, so the psychological distortion. Money illusion. It doesn't just hurt cash holders. The report says it also profoundly affects how equity markets are valued. This brings us to the Modigliani-Cohen hypothesis.
Right. This hypothesis, it actually came out of other high inflation periods like the late 1970s, and it suggests that high inflation structurally causes stock markets to be undervalued.
That sounds counterintuitive at first.
It does.
Why would that be? If inflation is high, shouldn't corporate earnings be rising as they pass on those higher costs to consumers?
Absolutely. And that's the intelligent perspective. Companies with real pricing power, think about the technology giants, essential service providers, large industrials, they are essentially inflation pass-through vehicles. Their nominal earnings and their cash flows grow in tandem with inflation. This means their real value is preserved, or in some cases even enhanced.
But the individual investor looking at the market doesn't see that.
Exactly. The individual investor sees the high nominal interest rate environment, like that 5.0% money market yield we just dissected, and they use that high nominal rate to discount future corporate profits.
And a higher discount rate means the present value of future cash flows looks lower.
Precisely. They are irrationally punishing the stock for the high interest rates that the central banks set to fight inflation, even though the stock's underlying real earnings are actually protected from that same inflation. It's a disconnect.
So if the S&P 500 is trading at a PE ratio of, say, 21x, which sounds historically expensive, the Modigliani-Cohen view would argue that this multiple is actually depressed relative to what the real future earnings justify.
Correct. The market is trying to find its equilibrium. And we see evidence of this tension in the persistence of the equity risk premium.
Which is the excess return stocks are expected to generate over the risk-free rate.
Right. And the source material pegs this premium at somewhere between 6% and 8% annually. That persistent premium is a signal that equities are still structurally undervalued because so much capital remains partially trapped by the nominal yield illusion.
So the intelligent decision for wealth preservation becomes unavoidable then. You must embrace equity participation.
You have to. Equities are really the only viable path to generating positive real after-tax returns in this environment.
But, and this is the massive pivot for part two, just buying the index in a standard ETF introduces a whole new set of crippling inefficiencies, all created by this new tax landscape.
Welcome to the OBBBA reality. And this structural section is critical because it explains why the old way is dead and what the new strategy must look like. The One Big Beautiful Bill Act, locked into law in mid-2025, provided 3 key fiscal certainties. These certainties form the foundation for every strategic wealth move in 2026 and really beyond.
Let's start with the first one, the certainty of high rates.
Key Provision 1, the permanent anchoring of the top marginal federal rate at 37%. Now, critically, this removed the previous threat of the rate reverting higher, maybe to 39.6%.
So it provides stability.
It provides stability, but the key insight here is the massive arbitrage opportunity that remains.
And you're talking about the spread between ordinary income and capital gains.
The 17 percentage point arbitrage. It's huge. Ordinary income like wages, business income, or interest is taxed at 37% federally. Long-term capital gains on assets you hold for over a year, are taxed at 20% federally.
That's a massive difference.
That 17% spread is not just a regulatory detail. It is the single most powerful lever for strategic tax planning. If you can convert what would be ordinary income into deferred long-term capital gains, you have instantly generated structural alpha.
Essentially, the government is telling high-bracket investors, we prefer you to be long-term investors in productive assets, and we are going to reward you handsomely for it.
Precisely. Okay, the second certainty, the net investment income tax, the NIIT.
Key Provision 2. The 3.8% IIT remains fully applicable to passive income streams for high earners.
And this is what pushes that effective federal ordinary rate to 40.8% and the effective long-term capital gains rate up to 23.8%. You must view the NIT as a permanent surcharge on wealth. The goal is to minimize it or avoid it whenever possible.
Okay, and the third certainty relates to corporate behavior. This feeds directly into our preferred investment mechanism, the stock buyback.
Right. The OBBBA maintained the stock buyback excise tax at a mostly symbolic 1%. It rejected all the political proposals to dramatically increase it, to quadruple it.
And what does that signal?
This is a legislative endorsement of the buyback as the preferred capital return mechanism. It tells us that corporations can and will continue to return capital to shareholders in a way that aligns perfectly with our goal, tax deferral.
So this fiscal certainty, high rates, persistent NIIT, and encouragement of corporate buybacks makes the next topic, the dividend drag, impossible to ignore.
It's the silent killer. And this is for anyone using a traditional S&P 500 ETF like SPY or VOO inside a taxable account. The dividend drag.
Talk about that. Most index ETFs are organized as regulated investment companies, or RICs. What does that mean?
It means they are legally required to distribute their income and their capital gains to shareholders annually. They're a pass-through. Now, the S&P 500 currently yields around, say, 1.5% to 1.7%. For the high-bracket investor focused on accumulation and preservation, those dividends they're like financial poison.
But wait, why are they poison if they're taxed at the preferential long-term capital gains rate? That's still better than ordinary income.
It is, but the problem is that they represent a forced realization of taxable income in the year they are received. You lose the power of timing. If you hold a stock that appreciates, you defer the tax liability until you choose to sell, maybe decades later. This allows the pre-tax capital to compound powerfully. When you receive a dividend, you have no choice. The tax clock starts ticking instantly.
The analogy I've often heard is that deferred tax is like an interest-free loan from the government.
That's a great way to think about it.
And dividends force you to pay back part of that loan immediately, whether you needed the cash or not.
That's exactly right. And let's bring back the quantitative analysis from the report to see the true cost of this drag. Let's imagine a $10 million portfolio invested in a standard S&P 500 ETF, and we'll say it's yielding 1.5%.
Okay, so that's $150,000 in annual income generated automatically by the fund.
And that $150,000 is immediately subject to tax. Even using the lower qualified dividend rate, our combined federal and state tax rate is approximately 37.1%. That's the 23.8% federal plus our 13.3% state example.
So on that $150,000 of income, the tax bill is roughly $55,650, and that's paid every April 15th, guaranteed.
And that $55,650 annual tax bill, it translates directly to a 0.56% annual tax drag on the total $10 million portfolio value.
Almost 60 basis points a year.
Just think about that. You lose over 0.5% of your portfolio every single year purely to tax friction generated by the fund structure itself.
And over a 30-year compounding period.
That 0.5% drag doesn't just reduce your growth. It amounts to millions of dollars in opportunity costs compared to a fully tax-deferred alternative.
So the standard, most efficient way to buy the market is now fiscally inefficient for the high-bracket investor. We have to solve the dividend drag.
We do.
This moves us into part 3, structural innovation and the price-only return principle.
This is the solution. It's the intellectual centerpiece of this report, the price-only return principle.
Define that.
The ideal taxable asset is one that delivers the full economic exposure of the market, the beta, but is structurally engineered to convert the character of the return entirely into unrealized capital appreciation.
So you're trading that immediate, highly taxed cash income for deferred, preferentially taxed price growth.
That is the conversion. And the beauty is that we have proven examples of this principle working at massive scale. Case study 1 from the report is the conglomerate shield. Berkshire Hathaway, or BRKB.
Many listeners probably hold Berkshire, but they might not appreciate its fundamental tax advantage.
Well, the advantage lies in its corporate architecture. Berkshire holds these huge stakes in dividend-paying behemoths, Apple, Bank of America, Coca-Cola.
Right.
When those companies pay dividends, they pay them to Berkshire Hathaway, the corporate entity, not to you, the individual shareholder.
So no dividend income ever hits the individual's 1099 form.
Zero distribution. Berkshire itself pays corporate tax on the income it receives, but crucially, it often uses the dividends received deduction, or DRD.
The DRD.
Which means it might only be taxed on, say, 20% of the dividends it gets from other U.S. corporations. After paying that reduced tax, the capital is immediately reinvested into Berkshire's operations or its portfolio.
And that reinvested capital increases the company's book value and, in theory, the share price of BRKB.
Exactly. The yield is retained inside the company, driving tax-deferred price appreciation for the shareholder. The BRKB shareholder gets no taxable distribution and achieves full tax deferral until they sell the stock. At that point, the gain is taxed at the lower long-term capital gains rate. It's just an extraordinary example of using corporate structure to maximize shareholder wealth preservation.
Berkshire is powerful, but it's also a single manager risk. You're betting on one team. What if an investor wants a pure, broad S&P 500 price-only equivalent?
And that's where modern ETF innovation comes in. Specifically, the report highlights the Roundhill S&P 500 No Dividend Target ETF, or XDIV.
XDIV. So this is the structural solution for broad index exposure.
It is. Traditional S&P 500 ETFs are legally mandated to distribute the dividends. XDIV is engineered to avoid receiving or distributing those dividends in the first place. It keeps the yield within the fund's net asset value, the NAV.
How is that mechanically possible if the underlying stocks are paying dividends?
The report details a couple of main methodologies. One is highly technical. It involves managing a constant rolling calendar of transactions where the fund sells a stock just before its ex-dividend date.
Okay.
Realizing the full value of the impending dividend as capital appreciation, and then immediately buying the stock back.
So they capture the dividend in the price rather than as an income stream.
Correct. The second method, which is often more cost-effective, is the use of financial instruments like total return swaps internally.
Swaps.
The fund enters an agreement to receive the total return of the S&P 500 minus the dividend portion. Or they structure the swap to only deliver the price return component. This allows the fund to strip out the toxic income component, retaining only the capital appreciation.
That's fascinating. The result is the same either way. The shareholder gets appreciation, not taxable income. Let's quantify the benefit again, because this is where that structural alpha is generated.
Right. For our top bracket investor, that 1.5% S&P 500 yield that is successfully retained inside XDIV, compounding tax deferred, it's equivalent to receiving a taxable yield of approximately 2.5%.
Wow.
That difference, 100 basis points or more, that is the tax alpha generated purely by selecting the superior structure.
That's a massive head start. It's like getting a 40% discount on the entry cost of your investment because you are eliminating that immediate tax friction.
And that head start compounds every single year. And this structural superiority has ramifications far beyond just the domestic U.S. investor. It's a magnet for global capital.
Let's discuss that. The global relevance. Why is a vehicle like XDIV a frictionless entry point for global investors, like, say, international family offices?
The main complexity for foreign investors holding U.S. assets is the U.S. withholding tax, which is often a flat 30%. And this applies to what's called FDAP income.
Fixed, determinable annual or periodical income.
You got it.
Basically, income that is predictable and thus easily taxed and withheld by the IRS. Dividends are classic FDAP income.
They are the textbook example. But XDIV, because it structurally avoids generating any distributions, generates zero FDAP income. This completely eliminates the 30% U.S. withholding tax for foreign investors who aren't protected by a specific tax treaty.
So it transforms the U.S. equity market from a tax headache into
a clean, simple, and maximally efficient vehicle for global wealth.
And this entire structure is reinforced by the government's policy decision on buybacks. We mentioned the 1% excise tax was maintained, reinforcing buybacks as the preferred method of capital return.
It's a perfect alignment. Buybacks are inherently tax-deferred for the continuing shareholder. When a company repurchases its stock, it reduces the share count, it increases your percentage ownership, and it boosts earnings per share. This entire process drives price appreciation, which is a tax-deferred event.
Right. Unlike a dividend, where you are forced to pay tax on the distribution, a buyback only triggers a tax event if you choose to sell your shares. You control the timing, you control the rate.
Yes. The collective corporate finance behavior is now structurally encouraging the price-only return principle. It aligns perfectly with the sophisticated investor's goal of tax deferral. This foundation, the price-only beta, is now ready for the final layer, the structural architecture required to generate high alpha returns on top of it.
That takes us into part 4, the architecture of structural alpha. So we're moving beyond simple buy and hold and discussing a bifurcated advanced strategy, the S&P 500 plus alpha hedge fund structure.
This is the core thesis refined. We're solving the fundamental conflict that sinks most standard taxable portfolios. And that conflict is this. Beta requires maximum tax deferral and extremely low turnover to maintain its long-term capital gains status. Alpha, on the other hand, requires high turnover, flexibility, and often results in short-term gains or losses.
And if you mix those two in the same bucket, the high turnover from the active trading strategy could taint the entire portfolio. It could potentially convert long-term capital gains on your core beta holdings into higher tax short-term gains.
It's the absolute destruction of your tax alpha. The solution has to be structural separation. The two pots.
Okay, let's define them. Pot 1 is the investment pot, focused solely on beta.
This pot holds, say, 90% to 100% of the core capital. It's invested in long-term, low-turnover, price-only assets like BRKB or XDIV. Its sole function is tax deferral and, crucially, collateral. These high-quality liquid assets serve as the prime broker's margin collateral, which unlocks the buying power needed for the alpha strategy.
And pot 2 is the trading pot, focused purely on alpha.
This is the high-frequency engine. It executes strategies like pair trading, statistical arbitrage, market-neutral mean reversion that are designed to deliver returns independent of the S&P 500's direction.
Okay.
And the key to making this alpha pot hyper-efficient is a specific IRS election, Section 475F mark-to-market accounting. This is what the report calls our tax unlock.
Before we get into the benefits, what is Section 475 in layman's terms? Why is it the tax unlock?
So Section 475 allows a qualifying trader to elect to treat their trading business as, well, a business for tax purposes. This means that at the end of the year, all securities held in the trading account are treated as if they were sold at their fair market value. They were marked to market.
Right.
And any resulting gain or loss is treated as ordinary income or loss rather than capital gain or loss.
That distinction, ordinary versus capital, that's everything in the top brackets.
It is. It provides two massive operational and tax advantages. Benefit A is ordinary loss treatment.
Okay.
Under standard tax rules, if your active trading strategy loses, say, $100,000 in a bad year, you can only deduct $3,000 of that loss against your ordinary income, like your wages or interest per year. The other $97,000 is trapped as a capital loss carry forward.
Which is minimal and delayed relief.
It's a trickle. But under 475F, That same $100,000 trading loss converts instantly into an ordinary business loss. It is fully deductible against all of your other ordinary income in that year. This is your tax insurance. If you earn $500,000 in salary and lose $100,000 trading, you are taxed as if you only earned $400,000. It transforms volatility relief from a trickle into a torrent.
That is huge for liquidity and risk management. What's the second critical benefit?
The freedom it gives to the trading strategy itself. The wash sale exemption.
Ah, the wash sale rule.
It is debilitating for active quantitative strategies. The rule disallows a realized loss if you buy a substantially identical security within 30 days before or after the sale. Imagine a strategy that trades leveraged ETFs like TQQQ and CQQ multiple times a day to capture quick movements.
Tracking and avoiding wash sales would be an administrative nightmare.
It's impossible, and it often makes economically sound trades unviable just because of the tax friction.
Yeah.
The tax tail starts wagging the investment dog. Section 475F, traders are fully exempt from the wash sale rules. So the alpha strategy can be executed purely on its economic merit, maximizing return without having to constantly worry about some technical tax rule trapping your losses or forcing suboptimal trade timing.
But this leads to a critical technical hurdle: segregation. If 475 is so powerful, why don't we just elect it for the entire portfolio, including our price-only beta assets?
Because that would be a disaster. It would mean our 8% annual S&P 500 gain would also be marked to market and taxed as ordinary income at 37% every single year.
Which would destroy the long-term compounding benefit.
Completely. We want the full utility of 475F for the alpha side, but we absolutely need the beta side to retain its capital asset status. This is the holy grail, the hybrid structure.
You can actually do that. Can the IRS really allow two different tax treatments within one investment vehicle?
They can, but the rules are extremely strict. The fund elects 475F for its core business activities, the trading pot. However, under the 475F rules, a trader must designate specific assets as held for investment, and this designation must occur on the day of purchase.
The day of purchase.
Well,
Not a month later, not a year end, but immediately.
precision is mandatory. There's no wiggle room. If the designation is correctly maintained and the manager doesn't actively trade those assets, then the beta assets, your XDIV, your BRKB, they retain their capital asset status. They are not marked to market. They continue to accumulate those beautiful unrealized gains, deferred until eventual sale, and taxed at the lower 20% long-term capital gains rate.
So it's like, if the investment pot is our long-term commercial property that appreciates slowly and is preferentially taxed, the trading part is our high-turnover, actively managed coffee stand out front that provides ordinary business deductions and quick gains. You're separating the two businesses within one ownership structure.
That analogy perfectly captures the required structural finesse. The separation maximizes loss utility and trading freedom on the active side, while retaining maximum tax deferral and preferential rates on the passive core.
So now let's look at the result of this intelligent architecture. The report has a hypothetical Table 2 analysis. This is the payoff. Let's assume the S&P 500 beta returns 8.0%, and the actively managed trading strategy generates 10.0% notional alpha.
Right, for a total gross return of 18.0%.
Now, in a traditional portfolio that achieved this 18% return, and where that return was fully realized as short-term capital gains, say in a non-475 active fund with high turnover, what would the tax look like?
The investor would be taxed at 37% federally, netting 11.34% after tax. A good return, but heavily eroded.
And what happens in the hybrid structure?
Well, the beta gain of 8.0% is unrealized and deferred, so it's essentially taxed at 0% today. The alpha gain of 10.0% is ordinary income under 475, so that's taxed at 37%, netting plus 6.3% after tax. The total combined realized after-tax return is 6.3% today, plus you have the deferred 8.0% beta, which continues to compound pre-tax.
So let's focus on the structural advantage in realized returns. By deferring the beta component, you've managed to realize an effective return of 14.3% in wealth growth. That's the 6.3% in realized cash flow plus the 8.0% in deferred appreciation.
Exactly. You have 14.3% net wealth accrual versus 11.34% net return for the fully taxable equivalent. That is nearly 300 basis points of structural alpha generated purely through the intelligent segregation and utilization of the tax code. The performance difference isn't in the stock selection, it's in the structural engineering.
And that structural alpha is the definition of deploying tax alpha technology. The asset performance didn't change, but the investors realized usable wealth changed fundamentally.
That's it.
This brings us to Part V, understanding how this specialized architecture aligns with broader institutional theory and the current regulatory landscape.
Wait, we're talking about the portable alpha renaissance. Portable alpha is a sophisticated concept. It's about separating the basic market return, the beta, from the superior manager skill, the alpha, and then acquiring them both efficiently.
It sounds like institutional jargon. Why is 2026 the year this concept moves to the forefront for individual investors?
Because the traditional framework, the 60-40 portfolio, is failing. It's just not working anymore. For decades, bonds, the 40, were negatively correlated with stocks, the 60.
So if stocks fell, bonds rose, providing a cushion.
A valuable cushion. It hedged volatility. But the sticky inflation environment has changed that correlation.
How so?
In an environment of normalized, higher interest rates and persistent inflation, bonds have become positively correlated with stocks, particularly during market stress events. The old safety net is gone. Bonds no longer serve the effective hedge they once were against equity downside.
So we need a replacement diversifier, one that provides returns entirely uncorrelated with the S&P 500.
And an uncorrelated alpha source is mathematically a superior diversifier than holding interest-sensitive bonds in this specific macroeconomic regime. It just is. Portable alpha allows the fund to maintain its high allocation to tax-efficient equity beta, that's the growth engine, while layering on an uncorrelated return source through market-neutral trading.
Which guarantees that if the S&P 500 is flat for a year, a dead money year, the fund still generates the alpha return of, say, plus 10%. It preserves the momentum of the client's wealth growth even in sideways markets.
And the hybrid structure we just detailed is the ideal mechanism for delivery. It uses physical tax-deferred beta like XDIV and BRKB instead of the expensive derivatives often used by large institutions, and then it ports the alpha return onto that beta foundation using margin. It's an efficient, robust, and now a necessary approach.
Necessary, but it requires a significant commitment, especially considering the recent regulatory tightening from the IRS regarding the 475 election.
This is a crucial risk factor that all managers adopting this strategy have to acknowledge. The IRS issued Revenue Procedure 2025-23, which fundamentally changed the flexibility of 475.
What did it change?
Previously, traders could sort of toggle the election on and off based on their short-term tax needs. Not anymore.
And now?
Now, revoking the 475 election triggers a formal accounting change that is difficult and slow to process. And, most importantly, it imposes a 5-year lockout period before the election can be made again.
So 475F is now a structural commitment, not a tactical annual decision. You are locked into that trading structure for half a decade.
Which highlights the genius of the S&P 500 plus alpha dual bucket approach. This hybrid structure is the only robust way to manage this lock-in. If the manager anticipates a period where the alpha strategy might underperform or volatility dries up, they don't have to revoke 475F and accept the 5-year lockout.
They can simply reduce the capital allocated to the alpha pot.
Exactly. They can reduce the buying power dedicated to trading down to near zero, but they maintain the 475 status for future use. Meanwhile, the investment pot of XDIV and BRKB continues to compound tax-deferred, completely unaffected by the reduction in trading activity. The structure itself hedges against the regulatory commitment.
That's flexibility achieved within rigidity. And finally, let's revisit the benefit for global investors, because the combination of price-only beta and the 475 structure creates an almost perfect pipeline for non-U.S. capital.
We established that the price-only beta, things like XDIV, generate zero FDAP income. That eliminates the standard 30% U.S. withholding tax on dividends, which is a major administrative and cost hurdle for family offices and sovereign funds.
Right. But what about the alpha side? Does the trading activity risk creating a tax nexus for the foreign partner?
That's the critical concern, whether the gains would be treated as effectively connected income or ECI, which triggers U.S. tax filing obligations. A huge headache. However, the 475 alpha strategy is generally protected by the trading safe harbor provisions in the tax code.
And what does the safe harbor provision protect?
As long as the foreign partners are passive and the trading activity is clearly for the fund's own account. So, not trading on behalf of others and not based on proprietary physical assets within the U.S., the 475F trading gains are shielded from ECI treatment. This provides the sophisticated foreign investor with a clean, low-tax, and low-compliance conduit into the U.S. equity risk premium.
Yeah.
It is. It's fiscally frictionless.
Okay, let's bring all of this home. The intelligent decision for 2026 is defined by architectural precision. It's about moving entirely away from these blunt, inefficient instruments. We've identified 3 traps to be avoided and 1 architectural solution.
The three traps are clear. 1. The money illusion trap. Holding cash or T-bills at 5.0% nominal yield is mathematically a guarantee of a negative real after-tax return in this high-tax, sticky inflation environment.
2.
The dividend drag trap. Holding a standard S&P 500 ETF like STY in a taxable account forces immediate, unavoidable, highly taxed income realization. It erodes your compounding power by nearly 60 basis points annually.
And 3.
The real rate trap. Relying on bonds for diversification and safety is failing because their correlation with equities is unstable and they suffer disproportionately in a sticky inflation, normalized rate world.
So the solution is the precision approach. Targeted beta exposure via price-only assets, combined with uncorrelated alpha via a 475 elected trading strategy, all housed within a segregated hybrid tax-aware structure.
And the difference in outcomes is not marginal, it's career-defining. Let's finish with a stark reality from Table 3 in the report, comparing the old models to this new architecture.
Okay, start with the traditional 60-40 portfolio. It's aiming for a 7.0% gross return, a mix of 8% equity growth and 5% bond yield.
That portfolio suffers massive tax drag. The 5% bond interest is fully taxed as ordinary income at 40.8%. The net effect, after you pay taxes and subtract 3.0% inflation, leaves a projected real after-tax yield of only 1.5%.
1.5%.
They're barely treading water. The compounding effect is negligible.
Now, contrast that with the optimized S&P 500 Plus Alpha Fund, which is targeting a 15.0% gross return, say 8% from beta and 7% from alpha.
Because the beta is deferred, so 0% tax drag today, and the alpha is optimized under 475, maximizing loss utility and minimizing friction, the portfolio is highly inflation protected. The projected real after-tax yield for that same high-bracket investor is a massive 9.0%.
9%. That is a six-fold difference in realized compounding wealth preservation. It fundamentally changes the time horizon of the investor.
It does. The report is clear. The S&P 500 plus alpha model is the logical and necessary evolution of portfolio theory given the OBBA tax code and the current macro environment. It exploits the tax arbitrage, it eliminates the dividend drag, and it respects the power of compounding by keeping capital working pre-tax for as long as possible.
So investing in such a structure isn't an aggressive play. It is simply deploying structural engineering to preserve capital in the face of high tax and high inflation rates. Wealth preservation is now determined not just by an asset's return, but by the tax code's treatment of that return.
And that leads to our final provocative thought for you, the listener, to mull over. Since the OBBBA has locked in the top tax rates and the 475 election is now a structural 5-year commitment, how might the durability and superior efficiency of this tax-aware structure fundamentally change the relationship between the sophisticated investor and the traditional financial institutions that still rely on the old, inefficient, fully taxable models? And what other esoteric areas of the tax code, perhaps involving foreign holdings or specific deferred compensation plans, might be hiding similar pockets of structural alpha just waiting to be unlocked?
Something to think about as you review your nominal yield statement next time. That's it for this deep dive. We hope we've given you the tools to move past the money illusion and into the new era of tax-efficient wealth preservation.